Good afternoon and welcome to HYCM's webinar FX Week Ahead live market analysis with myself, Giles Cochran, Chief Currency Analyst here at HYCM. I'll just give you all a chance to get on board as people are coming into the webinar. Just say hello to a few folks. Yeah. Hi Sammy, Van, Ravi, good to see you guys. Nadir, of course, Hashik, Anantre, welcome. I think it's your first time. Good to have you all aboard. And if someone could just type in the question panel so I know you can all hear me okay, and that's going to really help me. Ravi, can you hear me all right there? I think, yeah, hi Sammy, that's good, you can hear me. Got a question. Oh, that's great, Sammy, that's lovely. Who else is coming in? Mohammed, Raj, yeah, good to have you guys. Good. Well, welcome to the FX Week Ahead. We've got quite an interesting week. We've had a good start to the week, and we're going to be looking at what opportunities there potentially are in the coming week and what sort of events are particularly market moving as we start this new week. Before we start, just once again go through the disclaimer. I have to do it briefly each time, just making it clear that as we're going through these webinars, I'm not offering financial advice, I'm not offering signals, I'm not suggesting people trade certain currencies. What I'm trying to outline in this webinar is how you go about as a professional understanding what sort of factors you want to look at in trading currencies, you know, how central bank policy affects the path of currencies, and then how we go about applying that in a day-to-day basis. So this is all about education and helping us see what's coming up ahead. Yeah, thanks guys, that's good. It's good to have you on board. I think most of us are here now. That's great. So we can get stuck in. So before we look forward, of course, we want to look back, don't we? We want to look back to last week. And some of the key events last week were as follows. The Reserve Bank of New Zealand changed their forward guidance. Now, one of the things that you guys will have heard a lot of times from me who've been regularly attending these webinars is that currencies are primarily influenced by the forward guidance of central bank monetary policy. In other words, the central banks, they want a calm, they want a smooth currency, and so they tell the market what they're intending to do in order to try and keep as little volatility in their currency as possible. So last week, the Reserve Bank of New Zealand met. They kept their cash rate unchanged at 1.75%, which was what was expected. However, they had a clear move. Now, if you notice, this is from 27th of March last week. Look at the first couple of sentences. I set my alarm. I woke up at this time because I realized this was a potentially market moving event. And it was as soon as I heard this line, the official cash rate remains at 1.75%. Given the weaker global economic outlook and reduced momentum in domestic spending, the more likely direction of our next official cash rate move is down. So what the central bank has said is that we're more likely to cut interest rates. Now that's a move. They had been much more neutral, and now they've turned distinctly dovish. Now, for those of you who've been listening to my webinars for some time, what would you expect the New Zealand dollar to do at this point? Would you expect the New Zealand dollar to be bought, or would you expect the New Zealand dollar to be sold on this news? Give folks a chance to answer the question. Exactly, Sammy, you'd expect the New Zealand dollar to be sold. And that's the highlighted text. They also mentioned a number of different factors, they close at the end. The balance of risks to this outlook has shifted to the downside. The risk of a more pronounced global downturn has increased, and low business sentiment continues to weigh on domestic spending. On the upside, inflation could rise faster if firms pass on cost increases to prices to a greater extent. So this is an example of how you can trade these kind of situations, because as soon as I saw that the more likely direction of our next official cash rate move is down, I knew that instantly the New Zealand dollar was going to be sold. And so this is a screenshot on the 1 minute chart, and you can see that this was a trade I took. You can see the green line is the entry, the red line is my exit, and I just very quickly sold the New Zealand dollar. Now, I was trading the euro New Zealand dollar pair. That's the pair that I decided to trade in this instance, and the New Zealand dollar was sold, and so I just quickly took, it's around, so it's 1.64055, just over 1.4, so around 50 points that I just took very quickly in and out of the market. And as you see, I could have held it a little bit longer. I could have held it for a full 5 minutes, and I would have got a little bit more out of the trade. But I was just wanting to take my money off the table, and then I was looking to retrace selling the New Zealand dollar across a number of different pairs, and that retrace didn't come, but I got the spike on the initial move. So that's just an example of the sort of thing you're looking for. We want to see, we've got a rate statement coming out this week for the Reserve Bank of Australia, and what influences the currencies is the change in the forward guidance, okay? And there's only really three ways that it can go. Either they're going to raise interest rates, that increases the currency, cut interest rates, that devalues the currency, or keep things about the same. So they're the three different potential outcomes you've got. And of course, it's relevant what path the central bank is on. So we're always looking for a change in policy. That's where you get the result. That's where you get the impact. So that was the Reserve Bank of New Zealand. So just to be aware of that, their next policy rate cut is expected to be down. So log that in your memory banks. Brexit, of course, continued. This seems to be almost a never-ending saga, and it just goes on and on. And I live over here in the UK, and it's just a mess politically, and it's really frustrating to see Parliament constantly meeting and constantly achieving so little. And that's carrying on. So on Friday of last week, the withdrawal agreement was defeated again, this time by a margin of 58 votes. So now focus is going to turn to today for a fresh set of indicative votes. There's a new set of votes coming out today. And the key thing to watch is this group called the DUP. Now, for those of you who aren't familiar, the DUP are politicians in Northern Ireland. And when Theresa May called an election, she did so hoping to get a massive Tory majority to make it easier for her while she was making decisions in Parliament. It backfired, and instead of making things easier, it made things harder. And it was only with the help of the DUP that she was able to get a majority in Parliament. So it's a very finely balanced majority that Theresa May has, just very marginal. And with them not supporting Theresa May's deal, that is going to make it very difficult for the deal to pass. So one of the key focus is on this group called the DUP. So one thing to look out for is what the DUP say. Now, at the moment, the DUP are saying we don't support May's deal. We don't like the Irish backstop border solution. And as a result, we won't support May's deal. But if the DUP suddenly said we will support May's deal, that then we'd expect to see a strong bid in the pound. So that's something just to look out for. And if you look at the pound dollar pair, we can see that the pound is finding some support off the 100 and 200 exponential moving average. We can see that support level is coming in. We can see there is an ascending trend line that's been respected. If you just put this ascending trend line in here, that's kind of a respected level. And on the weekly chart, we can see that price is just coming back over the 50 exponential moving average, and we can see that price is kind of consolidating in. It's starting to coil in. And one thing to look at is as price coils in, as it gets more and more compressed, and you tend to see a strong breakout the other side. We are approaching a significant time now for the British pound, and a Brexit, there should be some kind of resolution or long delay or deal done. I would hope to see that within this week, although I have to say I keep saying that each week that I think the deal's going to be done, and each week it proves me wrong. So That's the key thing to look out for. That's what you guys need to be aware of. Look out for support of May's deal from the DUP. That will be the significant mover. Okay, there's a number of votes through today. We'll go through that later on in the session, but that was on Friday of last week. Now, on Friday of last week, we also had Canada's monthly GDP data. Now, this was expected to be better. There have been 2 months of declines at minus 0.1% growth. Now, that's returned with a plus 0.3% month-on-month reading versus 0.0% expected. So that was a really good result for Canada. Good boost to their GDP. And looking at the 1 hour chart, I was looking to enter a retrace at 50%. I missed the data as it came out, although that's a trade I would have liked to have jumped into. I just I missed it. And you can see here, this is the 1 hour chart. This is the US dollar Canadian dollar pair on the 1 hour chart. And you can see how quickly the Canadian dollar sold. Okay, sorry, how quickly the Canadian dollar was bought, and how quickly the US dollar Canadian dollar pair was sold. So that was a really good GDP data, and again, that provided a good example of when you can enter immediately into a news release. That would have been another good opportunity to just trade the spike down and to take some profit. And it's all to do with the deviation. You know, the expectation was about 0.0%, but the actual figures was 0.3%. So it was a 0.3% deviation. I did see some agencies reporting an expectation of minus 0.1%, so that would have made for a plus 4% deviation, which is obviously 0.4% deviation, which is obviously even better. So that was an example, and I am currently looking at entering a retrace on that move down. So I'm looking for a price to return up to the 50% fib retracement level on the US dollar Canadian dollar pair, and it's around that region where you've got the 100, 250 exponential moving average. Good result for Canada. But of course, when you're trading the US dollar Canadian dollar pair, which commodity do you have to be aware of? Little question for you guys. If ever you're trading the US dollar Canadian dollar pair, which commodity must you be aware of? Raj, Nadir, perfect. It's oil, because oil and the US dollar Canadian dollar pair has a 96% correlation. So as a result, you always need to be aware of what's happening with the oil markets whenever you're trading US dollar, Canadian dollar. Canadian dollar exports a lot of oil, so when oil's up, the Canadian dollar is strong. When oil is weak, the Canadian dollar is going to be pressured. That's the basic relationship to get. Last week, we also had inverted yield curve warning, which is seen as an indicator of recession. Now, for those of you who weren't here, I'll go very briefly, but last week we covered this in some detail, okay? So I won't spend a lot of time doing that now. If you're interested, go back to the website and look at last week's FX Week Ahead. We looked at the inverted yield curve and I explained it in a lot of detail. But essentially, the yield curve is the plot of the different maturity dates on the bonds and their yields. So in this example here, you know, a 30-year bond has like just over a 3% yield. A 1-year bond has, you know, a 0.25% yield. And essentially the basic relationship between yields and bonds is basically the longer the bond, the higher the yield. And that makes sense. You know, if you're going to lend someone money for 30 years, you're not going to see your money for 30 years. So you expect a good rate of return to compensate for the fact that you are saying goodbye to your money for a long time. So that's why a normal yield curve is the long maturity bonds have a high yield, the short maturity bonds have a low yield. You know, if that doesn't make sense, go back to the last week's webinar and check it in more detail. But that's the basic relationship. And so here is a typical yield curve. The longer bonds give a higher yield. Now the inverted yield curve is this. It's when the shorter bonds give a higher yield curve, when there's more demand for these shorter length bonds, 1 month, 6 months. And an inverted yield curve historically has signaled a recession. And in fact, the past 9 recessions, dating back to the 1950s, have seen the 1 year, which is this is the 1 year, and the 10-year yield invert approximately 14 months before a recession. So it tends to signal a recession. That's why there's been a lot of fuss, a lot of attention about the inversion of the US yield curve. So with the pound, just to be aware, there is a lot of headline risk at the moment. There's risks and opportunities. Obviously, one of the potential opportunities where the pounds can be moved is if the DUP suddenly get on board with Theresa May's deal. Rand Squawk do a free trial. And so if you were considering or want to know what it's like to trade with a squawk, this could be a really good time, because you get 1 or 2 weeks where you can do a free trial, experience what it's like to trade with a squawk, and you can potentially pick up some good Brexit headlines if you get the real-time full trial from Rand Squawk. So have a look at that. I know they do a 2-week trial. Obviously, I'm not affiliated to them or anything like that. I'm just letting you guys know good resources that are out there, and that's a good one that's worth trying now with a free trial. Yeah, start of the week, we've seen risk on, and the Nikkei was up plus 1.43%, the Hang Seng 1.76%, the Shanghai Index around plus 2.58%. So really good, strong overnight Asian equities. And they were rising on, a key bit of data that I was looking at, which is the very strong PMI data out of China. Now, the Chinese PM data was very good. Now, the official PMIs for March were 50.5 versus the expected 49.6, and services were 54.8 versus 54. So back in to growth figures, back into growth. And this is a sign that the Chinese stimulus measures are working. There's been a lot of stimulus in the Chinese markets, and this is just a sign that that's working. And the Chinese CAC-SEN PMI data was good too. Now, the difference between the two is this PMI data is the official PMI data, okay? The CAC-SEN PMI data is the private data, and this tends to look at the small to medium term businesses. The Chinese PMI data, the official one, tends to look at large organizations and groups that have government funding and much larger survey data. This is the smaller private one. So it's a good, between the two of them, it's a good indication. And the private data was good as well. It was 50.8 versus an expected 50. It's just worth sharing you the relationship between the Asia Pacific Index, which is in the blue line on the chart, and the China Manufacturing PMI. This is the official reading. So we can see here the official reading was 50.5. Here it is here on the chart, 50.5. The white line is the China official manufacturing PMI, and reading at 50.5, excellent reading. And looking at the Asian Pacific Index, you can see look, that the Asian Pacific Index since the start of the year has been rallying. There's been a lot of stimulus from China. The equity markets have been buoyed. And if you look back, the last time PMI data went from contraction back into growth, that sparked a nearly, that is 12, about 18-month period of growth in Chinese equities. So just to be aware that we've had Chinese equities rising since the start of the year, PMIs returning into positive territory, that could signal a continued rebound in Asian stocks. And that is what has been influencing the market this morning. It's that strong influence that, oh, hang on, risk is recovering, China's not doing as badly as we thought. So the markets are breathing a sigh of relief. Risk is now on. And here's a question for you. In a risk-on scenario, what would you expect the Australian dollar and the New Zealand dollar currencies to do? This is for some of you guys who've been attending my webinars for a while. What would you expect the Antipodean currencies to do? I'm having a look at the questions. Nadir, full marks, exactly, very good. Olufemi, very good as well. That's excellent. That's exactly what we'd expect. We'd expect the New Zealand dollar and the Australian dollar to be bought. So let's have a look at New Zealand US dollar. We can see, look, it's been bought overnight. Let's look at Australian US dollar, and we can see, yeah, look, it's been bought overnight and it's now falling, heading into some overhead resistance at the 100 exponential moving average. Obviously, what's going on here in the Australian dollar is we've got RBA rate statement coming out, so we're about pause. So that's what we've seen. Risk is not in the balance, risk is on. Sorry, apologies for that. That was a headline from last week which hadn't changed. So the higher yielding New Zealand dollar and Australian dollar currencies are bought on the improved risk tones. So Nadir, Olafemi, well done guys for answering that, and well done to the rest of you who knew the answer. I'm expecting this risk on sentiment to continue into the US session. Okay, obviously there are other risks, so just to be aware, there's risk of Brexit, US-China trade deal, there's Eurozone news, particularly sort of German manufacturing and general Eurozone risk. So looking at all that together, we can see, okay, we're entering Monday a little bit more optimistic. The Chinese data, both private and official PMIs, have indicated that the Chinese stimulus program is working. Asian equities overnight are recovering. We're on a slight risk on sentiment. We've got the Australian, New Zealand dollar currencies being bought. We've got Japanese yen being sold because, okay, we're not so risk averse. Excellent. This is the market situation we're in. So now we've got a handle on Monday morning. Let's now look at the week ahead and some of the significant top tier events that we have. So I'll just drag across our, here we go. So we've got retail sales, and retail sales have come out very soft for the US. That is a rough start to the quarter, and that is not so great, minus 0.4% and minus 0.2% for the retail sales. So US retail sales are saying that the consumer is feeling a little bit under pressure in the US. It's not a great reading for US. Remember, the Federal Reserve is on pause at the moment, and so this is not going to be a great indicator for them. However, if you look at some of the revisions, which I'm just seeing on the terminal here, I'm seeing that the prior US retail sales for February were revised to plus 0.7%. The autos were revised up to 0.3% versus minus 0.4%. So there's a number of good revisions. And the prior control group was revised up to 1.7%. Okay, so what we've got the data release, fresh data release today is poor, but some of the revisions are good. Okay, so a mixed bag out of those. We've got ISM manufacturing coming up as well, and construction spending, and more market manufacturing PMI data out. So quite a busy day for the US dollar. So expect the US dollar to be influenced by these readings. And remember, the Federal Reserve is on pause. So as a consequence, we're going to see data dependence out of the US. The Federal Reserve and the markets is going to be looking particularly at data for the US, so be alert to that. Also be alert to Governor Pollock's speech. Remember, we saw a much more optimistic a GDP figure out on Friday. Let's see how Pollock reacts to that potential risk for the Canadian dollar there. Watch out if you're trading the Canadian dollar. UK Parliament vote on Brexit. Now we'll cover that in a little bit. I'll go into more details. Let's see. Here it is. Yeah, now this is a situation. We've got 3:30. The Speaker of the House, John Bercow, will decide which motions to be debated. There's basically 8 choices for the House of Commons to make, and the Speaker will decide which to select at 3:30. So that's what to watch out for. Remember, if you want some up-to-date details on this, just go to the website forexlive.com and you can get free updated details on what's going on. 8 o'clock, the debate in the House will conclude and voting is expected to begin, and the official results are saying that they're due from 8:30, but in UK Parliament it tends to be, things tend to take a little more time, okay, and as a consequence of more time being taken, you can expect the results anytime from 8:30 to 10:30 now British summertime. We're no longer GMT time over here in the UK. British summer time, the clocks won't fall on the weekend. So remember that we're in British, these are British summertime dates and times here, okay? So big day for Brexit. Watch out what's going on. Potentially could get a move here in the pound. So watching very carefully. It's worth being around your terminals. If you can, and I think that's a bit late for you guys, isn't it? You're about +3 now, or +4 hours, so that would be 9:30 to 11:30. Yes, around midnight. It's debatable. I don't want to tell you guys who are in Dubai to stay up and lose your sleep, but just to be aware that this is a headline risk, and if we do get a deal arranged, the obvious target would be, let's have a look. The obvious target, if we do get a deal arranged, would be up here. If a deal is sorted, we're looking at testing 1.36 as a first target, and then up to those highs 1.4, 1.41, something like that. That's definitely a first port of call, and then it's up from there. We're just resting on that ascending trend line. Near-term risk can be defined and limited underneath this level here. You can see that the 100 exponential moving average, support, support, support. You've got multiple supports. You've got ascending trend line. You've got a move to the upside. So that is near-term support from now, and any risk can be defined and limited to underneath this figure. So, some traders are leaning against here, stops beneath the lows, and they're trying to play up to those highs. But obviously, remember, there is headline risk, and there's a distinct possibility that nothing gets done, no deal gets sorted. There's a hard Brexit, and if the Brexit is a hard Brexit, then we'll be looking at testing 1.20 in no time at all. Okay, so we go from here to there, and then a near-term risk can be defined and limited above these highs. So that's kind of what we're looking at here. We're looking at deal done 1.36, hard Brexit we're looking at 1.20. So we are really the market at the moment is factoring in, look, there's some kind of deal going to be done. This is optimism. The pound is rallying on this optimism, and it kind of makes sense that there's more likely at the moment for a deal to be done than not to be done. But as we know in the markets, there are no certainties at all. Okay. Next significant event we have is the RBA interest rate decision. We've got the decision and statement here at 3:30, and let's just check. So that is, I think that's 3:30 GMT time. So looking at the last rate statement, we saw that they revised down GDP growth and said underlying inflation remains low. Okay, so the RBA last time, if you look, and they said if there were then to be sustained increase in unemployment, a lack of progress in returning inflation to target, it might instead be appropriate to lower the cash rate. In light of the recent data and the inherent uncertainties around the forecast, the probability of these two sets of scenarios have shifted to be more evenly balanced than previously. Okay, the general market sentiment, I've been reading around on the Reserve Bank of Australia, and basically the major banks are forecasting the Reserve Bank of Australia to remain on hold, and if there's going to be a rate move, people are seeing the Reserve Bank of Australia as cutting rates. Okay, so remember what happened with the Bank of New Zealand and how they changed their forward guidance. So are the Reserve Bank of Australia going to follow suit? So that's what traders are going to be looking at, and potentially see a very similar trade to the one that I took last week for the Reserve Bank of New Zealand, and I'll probably set my alarm and pop myself up out of bed to see what's going on for that meeting. That's not too bad for you Dubai time. That's sort of about 6:30, 7 o'clock. So that's not too bad one for you guys to hit. Looking at Wednesday, we got some more non-facturing PMI coming out of the US. Again, we've already mentioned why the Fed is watching US data particularly carefully. And then the next sort of large events that we've got are the non-farm payrolls on Friday. Remember that really poor result we had last time of just 20,000 additional jobs, which are a real low number. So obviously the market's going to be looking for any recovery in that. The general consensus seems to be that was just an anomaly, a one-off blip. If you notice, every now and then you get like a really bad non-farm payroll number, like -33 here, just 38, and it seems to return. So you get every now and then you get little dips, 75, 126, but on the low side here, 2012, 45, and that just seems to be one of those dips. So obviously what the market's been looking at is the recovery. If there's another dip, then people are going to start asking questions, and that's going to be negative for the US dollar. And obviously average hourly earnings are very important as well, because the market wants, the higher that number, the better it is for the dollar. And obviously the unemployment rate. So you need to read these all together. And as of recent times, the average hourly earnings are as important as just the headline figure. So you need to take those all as a whole. Again, if you're struggling to interpret that, just go on a good website like forexlive.com, and some analysts will help you with that. Guys, that is what we have to look forward to for the coming week. I would say here, don't forget the coaching we offer. If you deposit $1,500 with HYCM, you get an hour coaching session with myself. If you do $3,000, you get an hour coaching session, an hour follow-up, and $10,000, you get 2-hour coaching session with myself and an hour follow-up and a 1-week VIP support, which is basically, you can send me emails and I'll try and guide and direct you in the right, with your thinking to see it's on the right way. And tomorrow, don't forget, at 1 o'clock to 2 o'clock GMT time, we have the workshop with myself. So if you're around, come back and join it. Thank you guys for attending. Thank you for your comments. Nadir, Raj, always a pleasure. Thank you very much. Sammy, Olufemi, thank you for your comments. And well done, guys. It's good to see some of your guys' knowledge really improving, and look forward to being in touch and seeing some of you tomorrow. If not, don't forget, same time, same place, and next week. Is it GMT? Yes, Nadir, that is 1 o'clock to 2 o'clock GMT. So British summer time, that's 2 o'clock to 3 o'clock. So 1 o'clock, 2 o'clock GMT time, and I'll see you tomorrow. Okay, guys, have a good one. Bye.